Hello everyone, welcome to our lesson on volume analysis. Volume analysis, in my opinion, is one of the most interesting topics in all of day trading. And I think for a lot of traders, it's a little bit of a light bulb moment that opens your eyes to what is really going on in the market. So we've got a lot to cover today, let's get into it. So in today's course, we're going to talk about what volume is and just simply how you read it, why it matters to us as traders. We'll then get into volume anomalies, and we'll talk about those single candle types from our previous lesson in relation to volume. And then we'll talk through each of our different volume profiles for the 4 C's of price action, again, that we talked about in the last lesson. Finally, we'll wrap up by revisiting support and resistance. All right, so we'll start off super basic with just how you interpret volume on your chart. Volume is the total number of shares that have been traded during a specific time frame. When you're looking at a candlestick chart, the volume bars, which are down here at the bottom, represent the same time frame as the candlesticks above. So here we've got a 15-minute chart of BABA, and you can see that this volume bar represents 15 minutes, and during this 15-minute time frame, we traded 1.3 million shares. So that's how you read volume on your chart. The last thing I'll say here is that these volume bars are typically colored the same as their corresponding candlestick. So you can see this is a red candle, and down here you have a red volume bar. This does not have any meaning to it outside of just making the charts a little bit easier to read. So now let's talk about why those small volume bars at the bottom of our chart are so critical to our success in day trading. And for me, this really boils down to 2 concepts. The first is that volume equals effort. This is the most foundational concept in the study of volume, and essentially all it says is that if you move really far in price, you have a large price move, that should require a large amount of volume, aka effort. Vice versa, if you have a small price move, that shouldn't take much volume to accomplish. Therefore, when the market's effort is not in line with the resulting price move, this is referred to as a volume anomaly. We'll talk about that a lot in the slides to come. Basically, you should think of volume as the validation criteria for a specific candle or candlestick pattern. The second concept that makes volume so important to us as traders is that it is one of the few tools that we have to identify when larger participants have stepped into the market. So larger players will be exercising larger share purchases because they have a larger bank account, and that increase in volume can signal to us that they have stepped into play. So that is an overview of why volume is so important. Now we'll get into some more detailed concepts. So we'll start by going back to our last lesson and the single candle types that we covered. If you remember, we had 3 different candle types. We had bear bull candles that represent clear directional sentiment, Doji candles, which represented indecision, and then hammer candles, which represented a change in sentiment. We're going to go through all 3 of these on their own slide, but this time we're going to do it through the lens of volume analysis. And volume will allow us to assess each of these different candles and assign it either a validated, suspicious, or anomalous tag. So let's get into each of these candles in turn. So we'll start with bear and bull candles. With this candle type, once again remember that volume equals effort. Because these represent a clear directional move, we should expect that directional move to be matched up with the level of volume that we would expect as compared to the averages. And to show you what I mean by this, let's look at a validated example. This dashed box here represents the average range of a candle for this stock. The dashed line down here represents kind of what is average volume for that time period of that day. You can see that this candle is validated because it is slightly above average, but you also had slightly above average volume. Therefore, volume equals effort, the effort and the size of the move match up, we can say this is validated. Now, when you need to start getting a little bit suspicious and maybe keying in a little bit closer to what's happening with the future price action is when you get candles like this, where it's a little bit below average volume, but it's above average in terms of the price move, or it's below average in terms of the price move, but it's average volume. So again, nothing to necessarily do here, but just start to be a little bit suspicious. Now, when you need to really key into price action and really start paying close attention is when you see something like these volume anomalies. You get a very high, above average volume move, but on a very, very small price move. And then over here to the right, you get basically no volume on a very large move. Both of these situations should really start keying you in to the fact that something is wrong in terms of price action, and you might be getting trapped in a move, or price might reverse. There's something that's not quite right here. So those are the volume profiles for a bear or bull candle. So let's look at a couple of validated examples here. You can see these three candles happened on above average volume, and they were pretty clearly a kind of average or slightly above average in terms of size. This one here would have been maybe slightly suspicious, and then this one here, again, is fully validated because it's above average volume, but it's a much larger up candle than you would have expected. You can see the same thing here on a chart of Facebook, or Meta as it's now called, and you see that you have above average volume on a pretty above average candle. Once again, above average volume on a pretty above average candle. So those are some examples of this in the real world. Now let's move on to the Doji candle. With the Doji candle, remember that this represents indecision in the market. If you'll say it this way, a war between buyers and sellers is taking place, and we don't necessarily know which one's going to win. The amount of volume for a Doji candle shows the intensity of that struggle between buyers and sellers. So technically, a validated Doji candle should have very low volume, should have much below average volume, because it's essentially no movement in price. So if you saw this candle here, you would say, yep, that makes sense. It's just a resting candle. It's a little bit of indecision between buyers and sellers. Makes total sense. As volume grows, you need to become more and more suspicious of this candle because this war between buyers and sellers is getting more intense. All the way up to the point where you really need to have alarm bells going off in your head because you see a Doji candle on significantly higher than average volume, which again is represented by this dashed line. So if you see this, you need to key in very closely to price action because the resulting move after you see these types of candles could be very dramatic. So let's see some examples of that next. So looking at a few examples of the Doji candle in action, you can see this 5-minute chart of SoFi. You have a Doji candle here on pretty average volume, and then the price move is a little bit dramatic but nothing crazy. You also have several Dojis over here in a row, some of which on above average or slightly average volume, some of which on below average volume, but the resulting price move once again is a little bit more dramatic but not totally crazy. So I would say all of these are maybe in the suspicious or validated category. Now, if you look at a 1-minute chart of NEO here, you can see that you have a large volume candle with a little Doji here. That results in a pretty large price move. And then over here, you have a very high volume bar with a very narrow Doji candle. And you can tell that after this, the price move is much more dramatic. So these would be two examples of suspicious or anomalous candles. Moving on to our third candle volume profile, we have the hammer candle. The hammer candle represents a potential change in sentiment. You would have had a strong bearish or bullish move, but buyers and sellers stepped in to essentially reverse that. So with this candle type, I want you to just start off being a little bit suspicious of it, because low volume hammers technically don't make sense because this was kind of a larger move, and yeah, the body of the candle was smaller, but the initial move itself was large, so you could be getting trapped. Or with average volume on a hammer candle, yes, this is the closest thing that technically would be validated, but this price action signal, the fact that you had a large sell-off move and then it was completely reversed by either the buyers or the sellers, really can't be ignored. So I don't ever really want you to quote-unquote validate a hammer candle. I want you to just start off being suspicious. Now, moving on to the anomaly case, this is any situation where you have a hammer candle on above average volume. Because once again, this represents the fact that buyers and sellers have stepped in mass to stop what would otherwise have been a directional move. Now, as I've said before, no single candle or no single confirmation can be enough to take a trade. there are additional items that we will learn in future lessons that we compare with the inverted or the regular hammer candle on high volume that can greatly signal a reversal in price. So let's look at a few examples of the hammer candle in action. Here on this one-day chart of NEO, you can see that we have an inverted hammer, and this is on pretty much above average volume. You'd say average would be maybe around here. So that directly precedes a pretty large move to the downside. At the bottom of this move to the downside, you get another hammer candle, this time again on above average volume, and that sparks a move, or at least a bounce, back to the upside. The same thing can be seen on pretty much all time frames. So we have a 5-minute chart here of SoFi that we saw in our last lesson, and you can see that they have an inverted hammer here on above average volume that precedes a very large move. You then have a very high volume hammer candle down here at the bottom, and this to me would have kind of signaled that this move was pretty much over. We do get a second retest of that level here, again on a hammer candle, and then you bounce back to the upside. So those are just a few examples of the hammer candle in action. So now that we've covered our single candle types from lesson 1.1, we're going to revisit the 4 C's of price action, but this time we're going to assign them a typical volume profile. As with single candles, each of these 4 C's of price action has a healthy volume profile. Any deviation from this volume profile can be a very powerful signal that we are potentially transitioning to either a new stage or at risk of being trapped in a false move. So once again, the 4 C's of price action are continuation, consolidation, constriction, and capitulation. And we'll take a look at each of their appropriate volume profiles next. So we'll start with the continuation volume profile. Volume during a trending market should clearly show that either buyers or sellers are in charge, depending on the direction of the trend. What this means is that when you get moves in the direction of the trend, you should have higher volume. And when you get pullbacks in the trend, you should see these on lower volume. So here's an example of a healthy trend. When you get a push up in price, you also get a push up in volume. Because remember, volume equals effort. We are moving a further distance, and new buyers are obviously stepping in to support price and push it higher. On the pullback, you should see a decreasing volume profile, kind of the stair-stepping down pattern. Because what this means is, 1, buyers aren't panicking, so they're not selling, and sellers or short sellers are not convicted, and they're not stepping in mass. So when you see this pattern, there's really no reason to believe that price won't continue pushing in the current direction. Now, when you should get suspicious that price might not continue in your direction, or it might fully reverse with a new trend, is when you see things like this. One example would be very high volume right at the top after kind of a weak or fairly normal push up, or increasing volume on the pullback. So we get a pretty large volume sell-off here on this second pullback candle. Or if you see something like a actual literal stair-stepping down, decreasing volume with the push-up, that should be very alarming. Again, here at the top, we get a high volume Doji candle, and then kind of the final nail in the coffin for this unhealthy trend example would be this kind of push-up on weak or average volume after that. This is a very common trap candle right here. So let's look at a few examples of this on real charts. So let's look first at a couple healthy examples of a trend in real life. Here we have a 1-day chart of Square, and you can see that it is moving down, and as we move down in price, we get a pretty clear increase in volume. When we have a small pullback during this larger downtrend, you can see that volume perfectly stair steps down and decreases. And then as the trend continues down, we once again get increasing volume. So there's no reason to think that this is going to do anything other than continue to sell off. Now, on the flip side, and on a 5-minute chart, we can see as price pushes up, we get an increase in volume, and as price pulls back, once again, we get a decrease in volume. So in both of these examples, there would be really no reason to exit your position if you were moving in the direction of the trend. There's no reason to think that a reversal is coming. Now let's look at some unhealthy or anomalous examples. So with our unhealthy or kind of warning sign example, I want to show you this 1 minute chart of NEO. And this is a perfect example of how you could use this to either exit or at least take profit on an existing trade. So let's say that you bought down here and you were trying to ride this trend up. When you should start to be suspicious first is you get, a strong push up on big volume here, but then as you pull back, there's a large inverted hammer on high volume and a pretty high volume doji candle right here. Then on this second push up, you get basically no volume stepping in until you get high volume again on kind of this inverted hammer doji type candle. Then when you sell off, you get increasing volume on the sell off, and then the last push up is fairly weak volume. So on this last push up, honestly, I would have probably been completely out of my position, or honestly, I probably would have been completely out of my position right about here. So let's see what actually happened. You can see that the next candle after this very weak attempt to break past this initial high, you get a very strong sell-off, and that sell-off kicks off essentially a reversal in trend. So those are some examples of healthy and unhealthy trends. Now let's get into consolidation. With consolidation, we first want to remember that it forms for basically 3 different reasons. Either broader market indecision, or a big player is accumulating or distributing shares before igniting a new trend. So therefore, when we think about the volume profiles, we want to think about it in terms of one of these 3 different selections. First, we'll talk about accumulation. Accumulation takes place when a large player is building a position in a stock. These huge players out in the market, think about hedge funds, other institutions, they can't just go buy 1 million or 2 million shares of a stock in one order, right? They have to accumulate a position across an average range because they don't want to spook the market and force price to move really far, really fast. And so you got to remember that these forces have enough buying power to basically force price to remain inside of a range. And with accumulation, you should therefore see volume be heavier at the bottom end of the range, right? Because they're trying to get the best price possible. So as price hits the bottom of this channel, you'll see a lot of buying step in. Again, a lot of buying stepping in as you hit the bottom of the channel. And at the top end of the channel, you'll see just enough volume to force us back down into this range. Distribution, on the other hand, is basically just the opposite. Now, remember, there's no such thing as a quote-unquote triple top pattern, okay? Distribution is not necessarily the same as capitulation, even though the result could be ultimately a reversal in trend, just like with capitulation. But with distribution, you want to see higher volume at the top end of the channel, and then just enough volume at the bottom to force us back in. So that's accumulation and distribution. The third option, which you generally want to avoid trading in, is called chop, or kind of neutral price action. Basically, this will happen prior to an event or earnings announcement, and there's really no way for us to predict which side it might break to because volume is pretty much average throughout this range, right? You can see down here in these volume bars, there's really no indication on which side the most volume is taking place on. So those are our 3 different options. Now let's get into examples of each. Before we get into specifics around these examples of accumulation and distribution and chop, I want to show you an indicator that can help you differentiate between the 3 options, and that's volume by price, or more specifically, VPOC. Volume by price is a study that shows you how much volume has transacted based on a histogram of price instead of time, right? So you have volume by time at the bottom of your chart. This now shows you volume by price. It also gives you this dark blue line, which will be VPOC. And VPOC stands for the volume point of control. Volume point of control. What this line represents is the single price at which the most volume has taken place. So with distribution, you would expect this line to be at the top end of the range, as you can see on this 1 minute chart of NEO. So the most volume that has transacted took place at the top end of our range. Therefore, we can identify that we are in distribution. Sure enough, price drops shortly after this. On the flip side of that, with accumulation, we should expect our VPOC, our volume point of control line, to be at the bottom end of the range, which is what you can see taking place here. So this study and the VPOC line, again, can just help us differentiate between whether or not we're accumulating, distributing, or we're in chop. So the last thing I'll show you with consolidation is an example of chop, or this kind of neutral, unsure price action. This is a 15-minute chart of Snap, and Snap had earnings in the post-market, so after the market closed. Everybody knew this, it's not a surprise or anything, and so the entire time, basically for the back several hours of the trading day, we just chopped sideways in a pretty narrow range, and you can see that the volume point of control was essentially in the dead center of this range, right? That's our blue line. So the most volume was taking place literally just straight in the middle. Buyers and sellers were conflicted. People were trying to take positions. You would have just been getting horribly chopped up if you were trying to trade during this. And you can see that once the actual news announcement, once the earnings call took place, we did get a very heavy drop. And this is where we opened essentially the next day, right? So we had a massive sell-off in the post-market and the pre-market. But the takeaway from this slide is that there is absolutely no reason for you to be trading in this kind of pre-earnings call chop range, okay? Particularly if you are able to use VPOC to identify the fact that all of the volumes taking place in the middle, it's just, again, a terrible choppy price action. This will lead to you getting stopped out multiple times. So that brings us to constriction. Constriction, in my opinion, is the most difficult to read, and so I've actually broken it out into triangles, which I think are easier, and then in separate slides we have wedges, which I think are more difficult to read. With triangles, remember that the idea is that we're trying to break through a resistance barrier. Okay, we've got this top side or bottom side flat area, and then an ascending move basically into a triangle shape. So because we're trying to break through this area, volume should be high as they attempt to break through this level. But it should generally be declining overall, because ultimately what a constriction is kind of a pullback in a larger move. So if you look at this healthy triangle example, we have declining volume overall, right? And it's not going to be super clear, but fairly declining volume overall. But then on all of the attempted breakouts of this triangle, we have much higher volume, okay? So that's what we're looking for with a healthy triangle. When you should start to be suspicious is if you have kind of elevated volume overall, but you have lower volume on the breakouts. So if you get a low volume break like this, when you've had elevated volume throughout the triangle, you need to be a little bit wary that you're basically getting trapped in a false breakout. Additionally, you should start to be suspicious if you have low volume across the entire move, right? Because constriction is supposed to represent a loaded spring. And so if you have no volume basically throughout it, then you're not actually loading a spring. There's no true constriction. So now let's look at a few examples. So here are some healthy triangle examples. And this is a one-day chart of Piton. Again, notice that I've got my volume by price and therefore VPOC indicator on my chart. And you can see that as we do this kind of sideways, slightly ascending triangle constriction pattern, each time that we sell off, it's on fairly low volume, and each time that we try to break through, it's on higher volume. And then when we finally do break through, we should see extremely high volume, which we do get, pretty elevated volume on this break. You can see the same thing on a 1-minute chart. Again, just trying to highlight with these examples that these things happen on all time frames. But with a 1-minute chart, we can see Ford has, again, the VPOC line at the top end of the triangle, which represents to us that most of the volume is taking place as we attempt to break, which is what we should expect with a healthy triangle. And then when we do finally break through, we get extremely high volume. So those are some examples of what you would expect for healthy triangles. Now I'll show you a suspicious or kind of anomalous triangle. Moving on to an example of a suspicious triangle. Remember that I said that in my opinion, constriction is one of the most difficult patterns to learn, particularly as it relates to its volume profile. And so, anything that is not perfect, in my opinion, should just start to give you alarm bells, right? Like if it's not extremely clear to you right off the bat, start to be a little bit hesitant. So here's an example of something I would be suspicious of, or you could even kind of consider this an anomaly for a triangle. This is a 5-minute chart of AMD. Once again, I have my volume by price study on here. You can see that most of the volume is taking place kind of towards the upper end of the triangle, which would be good. But what's very concerning is that on these sell-offs after touching the top end of this kind of significant resistance level, you get pretty high volume, okay? So you get elevated volume throughout. So now we're suspicious because volume should be generally declining and it's not. And you get very high volume on the sell-offs. The final piece that would kind of put the nail in the coffin, so to speak, is on the breakout here, you basically get no volume. It's definitely not extremely elevated like it should be. And on top of that, you end up closing this 5 minutes as an inverted hammer candle, again, on average or kind of maybe slightly above average volume. So that would be my signal to get out if I had tried to play this for a breakup. And you can see, sure enough, after that, we failed back down. So that's an example of when you need to start being a little bit suspicious of triangles. Okay, the second pattern that we want to talk about with constriction and the second volume profile is on the wedge. Wedges, in my opinion, are one of the most difficult patterns to read and utilize in your day trading. And so newer traders, I would kind of just recommend avoiding playing these altogether. But they're generally identified, again, by a tightening price range, and once again should be envisioned as a loaded spring. However, it's very difficult to tell which direction they're going to break because it's not pushing against one side, right? So it's not clearly trying to break through some resistance level. We're wedging in on ourselves towards this final break point. Because this is an indecision pattern, what we'll typically see with volume is that VPOC line right in the middle of our wedge. And later in this course, we'll discuss other tools such as Bookmap or Level 2 that can help us determine which direction this is going to break. But for now, the bias should generally be in the direction of the current trend if there is one. But I'll just honestly say that there is no, healthy wedge, and this pattern is always a little bit suspicious. So the general takeaways here are that with constriction and wedges, you should see volume generally in the middle of the wedge and generally decreasing, okay? Because once again, this is kind of a pullback, but it should be higher volume whenever you get to the upper bounds of the wedge, and it should still have very high volume when you break out of the wedge. So here are some examples of wedges. Here on NNDM, you can see that we clearly have a wedge forming, right? Both sides are kind of clearly constricting in on themselves. We have our declining volume overall, which is what we would expect. And then as we break out on this candle here, we do get elevated or at least above average volume. Once again, it's not fantastic, but the key takeaways are that you do see the volume point of control in the dead center of the range, and you do see a little bit of elevated volume as you break out. But once again, there's not a clear direction that you're going to break out. In this particular instance, again, the bias should have been with the general direction of this uptrend, but there's other tools that we'll discuss later to really cement, identifying which direction is more likely to break. You can see the same thing on a weekly chart of American Airlines. And once again, we've got our volume by price and VPOC line basically in the middle of this kind of descending wedge shape. And then on the break of that wedge, you do get extremely high volume and an extremely large move. So those are some examples of constriction and wedges. Remember, once again, just kind of start off being a little bit suspicious of this pattern, and don't feel bad if it's a little bit more difficult to identify early on in your trading career, because in my opinion, once again, it is one of the most difficult volume profiles to read and understand. So that brings us to the last C in our 4 C's of price action, and that's capitulation, which once again in this lesson I have split between double tops and bottoms and the head and shoulder pattern. Remember that capitulation patterns represent this last gasp of the market at the top or bottom of a move. As such, they should be accompanied by significantly higher volume, to the point where it is often referred to as climactic volume. So with a validated reversal, a true double top or true double bottom will show very exhaustive selling or buying pressure on the first high or first low. So you get this very, very high climactic volume candle on a narrow range at the top. You then fail down and you get a weak push, typically on lower volume, on the second top of the double top. This will often, once again, be met with higher or above average volume on a narrow range candle. Once you get this second narrow range, that normally is enough to ignite a trend in the opposite direction. Now, with a failed reversal, basically what you just need to be super careful of is that you're not mistaking a simple pullback for a double top pattern, right? If volume is strong into this first move, but not necessarily anomalous, and then the volume decreases on the pullback, well, that's literally just continuation volume. That's a healthy trend continuation volume profile. So you do not want to mistake that for a double top, even though the patterns can often look similar if you're just looking at the candles. So now let's get into some examples of this. So here are some validated double top and double bottom examples. So this is an example on a 1-day chart of Tilray, and here you can see extremely high volume on kind of this slightly large inverted hammer. You then get a very weak volume push up right here into another extremely large climactic volume inverted hammer. So on this second hammer, that would be a really fantastic sign that we're probably going to reverse in price or at least have an extended pullback. Now here's an example on a 1-minute chart of QQQ, and on the Qs we can see that we fail into this first level. We then hit very large volume as we go into the level and have pretty high volume on a narrow range candle at the bottom. Then we get an extremely low volume retest of this kind of bottom level. Okay, and this extremely low volume retest would be a really good sign that we're going to then reverse. And that's exactly what happens. So those are 2 examples of validated double tops. Now let's look at an example where you could get tricked into thinking it's a double top only to then have price move against you. So we look at a 1-minute chart of the Qs, and we can see that we move up into this inverted hammer, fail back down, and notice that on the push down here, again, we don't have, we kind of have this declining volume, so it's a healthy trend. And then on the push back up with this candle here, we get increased volume. And then when we fail back down the second time, it's on, once again, decreasing volume. So there's really not a great indication right here that price is going to reverse, right? There's no climactic volume. There's no standard volume profile for a double top. And you can see that basically that's exactly what happens is we just get a pullback, a slight kind of consolidation pullback in this ongoing trend, and we continue to move higher. So please don't get trapped trying to go short every single time you see this little double top pattern. You really have to have the volume profile to accompany it, or you're going to get trapped in moves over and over and over again. All right. So finally, we're going to wrap it up with the volume profiles by talking about the second capitulation pattern, which is the head and shoulders pattern. With the head and shoulders pattern, once again, the key price action takeaway is the market has hit a level of resistance, broke through that level of resistance, failed to push any higher, and then finally retest the original resistance level before buyers give up and bail, or sellers give up and capitulate if it's to the downside. So because this is what's happening, psychologically, therefore, we should see volume be elevated as it attempts to break through the initial level and bordering on climactic at the top. Climactic volume, however, is more rare on a head and shoulders pattern because the reversal is spread over a longer time frame. Okay? So this volume profile is not going to be as obvious or as eye-catching as the double top or double bottom. So with a validated head and shoulders reversal, you will see, once again, elevated volume on each shoulder. So elevated volume here. You will then see close to climactic volume or just very high volume on the top. And then you'll see a very weak and then stuff type pattern on the second retouch of the head. And then you should typically see volume almost accelerating as you fail off of this second retest. With a failed reversal, once again, I want you to think about the fact that you can have all different types of complex pullbacks in a trend, okay? And so you will even often get things that look like a head and shoulders when in reality volume is kind of decreasing throughout or not fitting this healthy, validated profile, and you're going to get trapped once again in a false reversal. So if volume remains generally low or is aligned more with our trend volume profile, you need to stay away from it. So to wrap up capitulation, let's look at two quick examples of the head and shoulder pattern. So here you can see on a 1 minute chart, this pattern forms. You get elevated volume on an inverted hammer kind of as you attempted to break through. You then get very strong volume up here at the top, right? So very climactic, kind of, maybe not climactic, but very elevated volume at the very top. And then you get a very low volume retest and stuff on this second touch of the shoulder here. So that's a kind of validated head and shoulders pattern. Another example of that on a 1 day chart, we can see with DK and G, once again, elevated volume on this first shoulder, higher volume as we get to the top of this range, which again, it's going to be a little bit less obvious, particularly on a daily chart. And then once again, very low volume retest of this second shoulder pattern, and then a failure. So those are two examples of head and shoulder patterns. Let's wrap up today's lesson by revisiting support and resistance. So remember in our last lesson, we talked about the first three concepts of support and resistance. And I left off concept 4 because I wanted to talk about it particularly in this lesson since we are talking about volume profiles. So concept 4 states that the strength of a support and resistance level is often a function of volume and time. So levels closer in time, more recent to your current price action, with higher volume tend to be stronger than those that are further back with very little volume. Now let's look at an example of that. So let's wrap up today's lesson by showing you an example of this concept. We look at a chart here, 5 minute chart of Meta, and we can see that we have a very large sell-off in this trading session. I once again have volume by price on my chart, and we can utilize that and the VPOC dark blue line, the volume point of control, to identify that most of the volume for this session was around low of day. So a lot of people stepped in and either exited or bought into positions here. Price closes right here, and you can basically see that the volume point of control, the single price at which the most volume transacted, was basically at low of day, around 225.30. So let's see what happens in our next session. In the next session, we can see that price opens here, moves up, and tests this line, fails, tests previous day close again, which again was our volume point of control for the previous session, and then proceeds to fail for the entire rest of the day. And if we think about this from a psychology perspective, what has happened is that a ton of volume came in at the low of day yesterday. So there were a ton of people that decided, hey, this is the bottom of meta. I'm going to step in and I'm going to purchase. I'm going to try to time the bottom. The next trading session, they open and they're actually underwater on their position. So they're panicking. So when price moves back up to the point where they bought in the previous session, most of them, or a lot of them, are exiting their position. Okay, they're saying, okay, I'm just going to get out at break even. I don't want to mess around with this anymore. I don't want to try to time a reversal. You also get another participant group that is coming in and shorting this level. Because once again, remember back to our previous concepts, support becomes resistance and resistance becomes support. So this was support yesterday, it has now become resistance. The combination of those two groups reacting in the same way causes a massive sell-off. So when you're considering levels to play intraday, think about things like the previous day high, the previous day low, or the previous day's closing price, because you're going to get a lot of kind of immediate reaction to those levels because they're very fresh on traders' minds. So that's an example of concept 4. We can wrap today's lesson up. All right, so that brings us to the end of our lesson on volume analysis. I know this was a little bit of a longer lesson, so I appreciate you sticking through all the way to the end, and I want to leave you with just a couple of quick closing comments. So first, remember that the combination of volume and candlesticks is what arms you with a very powerful toolkit to interpret the market auction process. Second, and if you take nothing else away from this course, just remember that volume equals effort, and all of your future price action analysis should be viewed through this lens. So with that, we'll end this lesson. Again, I hope you got a lot out of it, and I'll see you in the next one.